Good afternoon. My name is Grace Kawango. We are going to talk about job costing, which is a topic in cost accounting, which talks about costing a job. So, what is job costing? Job costing is a type of costing that is assigned to a specific type of costing where the price is only arrived at after the supplier is aware of the customer's requirements. Well, for example, we're going to look at, for example, if we're looking at custom made outfits. So, when you look at custom made outfits, it's very difficult for a tailor to come up with a price because each suit has different specifications for a client. It could be the size of the client, it could be the material and the design that is different. We can also look at example of a house. If a house has to be refurbished, there are different things that a client would want when they are looking for to renovate or refurbish their house. It could be the color, the type of paint, the type of ceiling they want. So that type of specific order quantity where the price is only arrived at after the specifications of the clients are known is what is referred to as job costing. So job costing is only for custom made type of business. So if you're into a business where you make custom made things, then the type of costing that you need is job costing, and the price is only arrived at when you know the profit margin that you need and the type of costing that you are using, whether it's based on marginal costing or it's based on absorption costing. So if it's made based on marginal costing, then you only look at only variable costs that have gone into the production of that particular cost object. And if you're looking at absorption costing in job costing, you're looking at all the costs. That's inclusive of variable costs and fixed costs. So the difference between marginal cost and absorption costing is only an addition of a fixed cost. The absorption costing takes into account the fixed cost component, and the marginal costing does not take into account the fixed cost component. So once you know the difference between the two, then you can easily come up with a price since you already know the customer's requirements and the costs that will be involved in producing that particular cost object. So basically, then from there we proceed to computations of job costing itself. So there are formulas that are involved in job costing, and you need to understand what goes into job costing. So it's not every other cost that you look at in terms of cost classification. So it's only the costs that are directly linked to that particular cost in addition to the fixed cost which you are going to incur, which for example like rent. So as you are costing a product, you need to know that you also dig into the fact that you are paying fixed costs such as rent. So this is an overview of job costing. Thank you. Today we're going to look at what is known as standard costing and variance analysis. So before we go into deep down into this topic, we first need to understand what standard costing is. So what is standard costing? So standard costing is a type of costing where you have predetermined costs or budgeted costs compared against standard costing. So you'd have to compare budgeted figures and actual figures. So the difference between actual figures and budgeted figures is what is known as a variance. Actual figures there is what is known as a variance. So A variance is the difference between standard costs and standard and actual figures. So, an analysis of the variances is what is known as the variance analysis. So, an analysis of the variances or the differences, or let's say the differences is what is known as variance analysis. So when you analyze the results that you have after you deduct standard figures, actual figures from standard figures, what you have is known as a variance, and an analysis of these figures is what is known as a variance analysis. So variance analysis has two results or outcomes, two outcomes which are favorable outcomes, favorable outcomes, or you can have a favorable outcome and then you have an adverse outcome. Okay, so what does it entail? A favorable outcome arises when the actual figures are better than the standard figures or the standard costs, and an adverse outcome results when the budgeted figures are better than the actual figures. So I would also want to urge the students. So under standard cost or variance analysis, we do not use the terms positive or negative to mean positive or negative to mean adverse or favorable. So what we do here is we just compare the results, and if the actual figures are better than the budgeted figures, you have a favorable outcome. And if the standard figures or the budgeted figures are better than the actual figures, then you have an adverse variance. So a negative or positive does not mean, I would want to highlight this one as well. A positive does not mean that the variance is favorable, and the negative does not mean that the outcome is an adverse. So, and actually, in most cases, usually where you have a negative variance, if you're using the formula, you would have a favorable outcome, and where you will have a positive answer when you're doing your calculations on your phone, you actually have an adverse outcome. So, how do they arise? Let us give an example of something. Let's say you budget to buy something at 10 kwacha and you find it at 8 kwacha. So when you budget to buy it at 10 kwacha and you find it at 8 kwacha. So in this case, the actual figure is 8 and the budgeted is 10 kwacha. So in this case, you compare the figures and the actual figures. So which one was the actual amount to be bought? 8 kwacha. And which one was budgeted? 10 kwacha. So we budgeted more than we bought. It means that we made an extra 2 kwacha profit on us. So it means that the outcome is favorable because we're saving on the money. So that should be the mindset. What are we dealing with at this point in time? Are we dealing with variances on labor? Are we dealing on variances on sales? Are we dealing on variances on price, on material, on overhead? Variable overheads, or are you looking at variances which are fixed overheads in nature? So each variance is treated separately in the sense that how you treat material variance is not how you treat usage variance. The price and usage are two different things. So the more you save on usage, the better the outcome, and the more price the less the price that you spend on something, the better for you. I hope that makes a bit of some sense. So let's come to that point. So let's look at types of variances. So we have types of variances. So let's look at the types, okay, of variances. So types of variances. We have what we call ideal variances. Ideal variances. So ideal variances, these are variances that assume that in the in the process procedure or in the manufacturing process procedure, there will be no losses or anything that will affect the production. Do we see where maybe if you're producing, let's say, a bottle of Coke, or anything that is produced, for example, in batches. Once you produce, you'd have certain items that are substandard. Maybe the bottle itself is not as straight as the others, or maybe the cap is out of the process, or the bottle breaks. So with ideal variances, it assumes that if you plan to buy something at 10 kwacha, you should find it at 10 kwacha, holding other things constant, like there will be no lessage, there will be no wastages, there will be, the goods will not go absolute. So those are what we call ideal standards. Then we have what we call basic standards. Basic standards. What are basic standards? Basic standards, these are standards that were set a long time ago and have not been updated over time. So these are basics. These are more like foundational standards. These are standards that are foundation and they've never been updated. You can have a standard. For example, I'll give an example to say my standard at this point in time is to go, and for example, if I have a standard, I'll say, okay, fine, I'm done with uh, my education. My only goal is to get a degree. Once you get to a degree, you'd want to do a master's, you'd want to do a PhD. But a basic standard does not look at that. If the goal was just to get a BSc and it ends at a BSc, okay, then we have what we call attainable standards. Or we can start with current standards. Current standards. So current standards, these are standards that we are trying to achieve currently. So if our goal is to achieve a certain standard, is in a month I should only be spending 5,000 kwacha at most. So that means that is a current standard. I'm only trying to reduce my expenses so that it just the expenses will just be within a 5,000. So that means that is a current standard. Then we have what we call attainable standards. Attainable standards. So attainable standards, these are standards that we are currently working on and can be achieved. For example, we set the goal that I would want to get an A plus in digital content creation. That is an attainable standard. Why? Because the grades, you can even get marks out of 100. So that means that it's something that is attainable. Even if I'm not trying to pursue it at this point in time now, it means that it's something that I'll achieve and I'll just set a goal to say, this is what I want to be. So those are what we call attainable standards. So these are the main four types of standards in variance analysis. Thank you for listening to my learning session. I hope you have learned something. Thank you.